Welcome Investorholics, my subscribers and all those new to the channel. This is ETF Spotlight Review. Today we'll be looking at SYI, which is the State Street SPDR MSCI Australia Select High Dividend Yield Fund. So SYI fully replicates the MSCI Australia Select High Dividend Yield Index. State Street SPDR and MSCI have customized the index, which follows the rules-based dividend overlay, delivering above average yield and franking. The ETF prudently manages dividends using cash, futures and reinvestment, preferring to be fully invested but cognizant of trading costs. The resulting portfolio is slightly more concentrated than competitors with 35 to 40 holdings and marginally higher turnover. Hang around, guys. This is a good one if you're looking for income. Well, hello there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. So SYI seeks to closely track before fees and expenses returns of the MSCI Australia Select High Dividend Yield Index. So the index, the MSCI Australia Select High Dividend Yield Index, is designed to reflect the performance of the listed Australian companies with relatively high dividend income and quality characteristics, with the potential for franked dividend income. The why factor, why would you bother with this one? So if you're looking for income, this might be one to look at. There's also a bit of capital growth associated with it. So you earn potential quarterly income from companies with relatively high dividend yields with potential for franking credits. Diversification, so you gain diversified exposure to a range of Australian companies across a broad economy, excluding REITs, which is the real estate investment trusts, through a single trade. Growth, potential to capture stock price growth opportunities over the long term, so not just dividends, but there's also a little bit of a chance of return on your investment, some capital growth. SYI specifically targets companies with at least 5 years track record of dividend consistency, sustainable dividend payout ratios, quality and performance. The purpose of these additional criteria is to reduce the chance of companies cutting their dividends, also known as a dividend trap. So they've got a few extra screens which might help the ETF perform better over the long term. So it had a net asset value of $25.32, trading just above that, just below that actually, at $25.30. Market cap of 168 million, management cost of 0.35%, quarterly distribution January, April, July, October. Dividend yield fluctuates a bit because there's a bit of movement in the market at the moment. So when I looked at it last, it was 6.29%. Recent pullback in the ASX could be a great time to pick up shares in SYI. It is a well-diversified income-focused ETF. The ETF has gathered a group of high-yielding ASX shares that are ready and willing to go to work for you. Some of its largest holdings currently include Commonwealth Bank, BHP, Wesfarmers, with an average earning multiple of 15.56% and trailing yield above 6%, or at the current market it's above 6%. So SYI is designed to give you an ongoing stream of cash to plow back into your portfolio or spend as you see fit. I think the ETF could be a useful stock to hold in your portfolio for the long term. As with other income-focused ETFs, you know, they have a relatively high concentration of portfolio. This one holds sort of between 30 to 40 stocks. SYI is a great option for investors seeking cost-effective exposure to a high dividend-paying Australian stocks. So, you know, if you're chasing yield, or, you know, if you're looking for a dividend to help you live, it's not a bad idea. Or alternative, if you are a long-term investor and you're a young guy or a young woman, this can actually help generate cash to actually, you know, reinvest back into your share portfolio, help it grow faster. If you're looking for some other alternatives, which we should, because we want to do some comparisons before we actually invest, have a look at VHY and IHD, some other alternatives that can help you along in your investing. But as I said, make sure that you're actually doing your research and going back and checking those and actually making the right assessment. And if you need further advice, always speak with your accountant or your financial advisor as required. So let's look at the couple of graphs. We can see the main holdings there on the right hand side. So ANZ, Commonwealth Bank, BHP, Wesfarmers, Macquarie, Woodside, Rio, Fortescue, IAG and QBE. So a bit of a mix of sort of banks and sort of industrials and a few insurance companies. Since inception, you would have done okay, sort of 7 or 8% over the long term is not too bad, plus the dividends. The SYI attempts to minimise the risk of dividend traps by excluding companies with unsustainably high dividends, poor track records of paying dividends, high debt, low return on equity, and high earnings volatility. So they were kind of those extra screens that I sort of mentioned at the start of the presentation. So they tried to actually do their best to avoid those dividend traps by those couple of extra screens. So on the whole, I think if you're looking for something with a higher dividend payout, you know, this one pays your dividend quarterly. It's probably not a bad one to have a closer look at. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.